Howard Marks, Mastering the Market Cycle, Getting the Odds on Your Side. Dive into the insightful world of investment and financial market cycles with Howard Marks' book, Mastering the Market Cycle, Getting the Odds on Your Side. This summary will guide you through the complex maze of investments and market fluctuation, helping you to make well-informed decisions. Unravel the true value of assets, pitfalls of long-term forecasting, and the importance of understanding market cycles. Learn to recognize the repetitive pattern of boom and bust, examining the role of human emotions in driving market fluctuations. You'll gain valuable insights into the mindset of a superior investor along with some striking real-life examples, all presented in an engaging and user-friendly language.
Mastering the art of investing. An investor's job is to invest in a range of assets, known as a portfolio, in the hope that it will increase in value over time. However, it's impossible to predict the future with any accuracy, so investors must discipline themselves in the art of making educated guesses. The key is to focus on the knowable, which is all the information you can gain about the true value of a given asset. The goal is to buy assets when they are cheap and wait for developments in the market to bring their price up. Additionally, a superior investor should consider financial cycles as a third component in their investment strategy. Understanding market cycles. The author defines a cycle as a repetitive pattern and draws parallels between natural cycles and market cycles. Although market cycles are not as predictable, informed investors can anticipate market changes. After a market boom, a bust is likely to occur, and investors can prepare their portfolios accordingly. This passage explores the tendencies of the market in the short term and the long term and emphasizes the importance of situating oneself within market cycles. Financial cyclicality and the dot-com bubble. Financial cycles follow a repetitive pattern of growth and oscillation around a secular trend. The dot-com bubble of 1995 to 2002, fueled by the incaution of venture capitalists investing in online companies, is an extreme example of this pattern. The bubble resulted in many companies failing, venture capital investors experiencing losses, and a sharp decrease in stock prices. However, on average, the venture capital market has grown over the last 20 years, with wild short-term variations. Cycles in markets, economies, and companies tend to follow this pattern, which we'll explore more in the next part. Emotional extremes and market fluctuations. The book explains how human emotions, specifically euphoria and fear, result in market ups and downs. During times of growth, investors become delusional and start buying excessively, leading to a market boom. However, fear eventually sets in, causing investors to sell and prices to plummet. The herd mentality is difficult to resist, showing that staying level-headed is key. The superior investor. The key to successful investing lies in paying attention to risk premiums and understanding market trends. As the author points out, investors often make the mistake of believing that investing is risk-free during market upswings, and high risk during downturns. However, the opposite is true. The best time to invest is during a slump, when risk is at its lowest and the potential for market upswings is highest. The author illustrates this point with the example of the U.S. housing market in 2010, which was highly depressed but had an increasing population, indicating the potential for increased demand. By focusing on risk and market trends, investors can become superior and make profitable decisions. Understanding secular trends. Secular trends of GDP are the backbone of the economy, and it's crucial to comprehend how they vary over time. The growth rate is not only dependent on the number of hours worked but also on productivity. The baby boom phenomenon is an example of how the employment rate dictated the growth pattern. In contrast, technological progress triggered substantial economic growth between the late 1700s and early 1800s. Hence, it's not prudent to bank on future growth without paying attention to short-term cycles.
Howard Marks' Mastering the Market Cycle, Getting the Odds on Your Side, offers a comprehensive understanding of the intricate world of investments and market fluctuations. By exploring various market cycles, the book highlights the importance of making informed short-term predictions based on valuable and unknowable information. It emphasizes the role human emotions, particularly fear and greed, play in driving market fluctuations, while also diving deep into the secular trend that takes much longer to play out. By the end of this journey, you'll be well equipped with the necessary tools and mindset to become a superior investor, someone who remains alert to short-term cycles and positions themselves advantageously for financial success.